So good morning, everybody. Hope you can hear me. So the others will join us and they are joining. The numbers are increasing. They will join us and find us along the way. So to begin off, thank you so much for the participants. And just some ground rules before we begin this master's training course on investor readiness for import and export business. The participants, it's your option to either use the video or not. Use the chat box. We have unmuted all the participants so that we don't have disruptions within the training, but feel free to use the chat box and raise your hand, and then we can unmute you when the time comes for questions and maybe another clarification. So at this juncture, we have two of our experts who will be taking us through this training. My name is Dr. Jackson Koimbori. I work with KEPSA. KEPSA is the Kenya Private Sector Alliance, and we are a membership organization where we have over 2 million members and over 80 BMOs within our membership. So our members are mainly focused on matters import, export, and anything matters business. And that's why we saw this training very pertinent. And we made it open not only to KEPSA members, but to non-KEPSA members. So within this call, we have KEPSA members and non-KEPSA members. So before I begin, I will start with just a small brief on Kature, who will be able to take us through the training as one of the trainees, and also Doreen. But before I do that and give them the floor for them to come straight in, I think it's my privilege to start off by saying Kature Nyamu is a seasoned business leader with over 28 years experience in financial services and a proven track record of building and scaling high-performance businesses. For the past decade, Kature has served as a CEO across leading investment firms, where she has driven transformative growth, led complex integrations, and delivered superior stakeholder value. One key undertaking is that she has successfully built greenfield businesses in asset management and brokerage, grown assets under management from Kenya shillings 800 million to over Kenya shillings 52 billion. Apart from that, she has worked with other key leading institutions, and under her leadership, the NCBA Investment Bank became Kenya's second largest unit trust fund manager within a decade, consistently delivering over 20% annual revenue growth. So in short, without going so much into her experience, the summary is that she has over 28 years of experience, and I've mentioned the few key areas where I've said even a career has spanned over regional institutions, be it the NCBA Investment Bank that we all know, the CBA Capital, Price Waterhouse Coopers, Deloitte, and many more. So with that, we have Kature as one of the trainers. And without wasting any other time, maybe Kature can say hi to them before I go into Doreen.
Good morning. I am excited to be here with all of you. Thank you.
Thank you so much. And our next trainee is Doreen, who will be taking you through the second part of this course. So on the part of Doreen is that she is a seasoned transaction advisor with over a decade of experience in helping businesses raise capital across sub-Saharan Africa. She works with founders, directors, and managers, helping them to strategically position their businesses to attract capital from both local and international funding sources. In terms of her portfolio, is that Doreen expertly manages the entire fundraising process, from crafting compelling pitch decks and financial models to navigate due diligence, securing contracts, and facilitating capital drawdown. Her contributions have been instrumental in Stadia Capital, company that has raised 500 million USD for businesses across sub-Saharan Africa, with typical capital raises ranging from 5 million USD to 35 million USD. So Doreen has previous experience as a tech founder, having established CDD Professionals, a tech platform that connected blue-collar workers with job opportunities in East Africa. So in this role, she was responsible for everything from strategy development and fundraising to client relations and operations. So in short, also in terms of her experience, is that in financial risk, she has gained valuable experience in financial risk assessment as an actuarial analyst, at Alexander Forbes. So in short is that, or in long is that, we have a combined, or the trainees have a combined experience of over 38 years. That is 28 years for Kathure and 10 years for Doreen and more. I won't be counting mine as the moderator, so maybe it's around 10. So we are coming to 50 or 40, but on a light note. So maybe before I waste any further time, Doreen, you can say hi to the participants, and then I can hand it over to Kathure, who will be able to take the team through this training. And before I hand it over to Doreen, the participants, I would like to brief you that this is the first series of trainings, and that's why we have made it 2 hours long, so that people can understand why do we need to come for this full training course. So the full training course will be held sometimes in January, and we wanted people to come and understand what will they be expecting in January. So the full training course in January, participants will be given the combined certificate after the second training. The second training, which will be happening in January, will be telling you more about this once we conclude this training at around 10:30 today. So Doreen, maybe say hi to the team, and then I hand it over to Kathure.
Hello, everyone. Looking forward to engaging with you more a little bit later.
So thank you so much. And for purposes of video clarity, I would ask everyone else to unmute, to mute their videos. And Kathure will have her video up as she projects the screen. So Kathure, over to you. It's now exactly 8:44. You have around until 9:30 there, before we tell Doreen to come in. We'll not be having a break in between, so people can have their breaks. They can take their own breaks as we continue, so that we finish at exactly 10:30. And this is just a brief overview before we go into the real training session, which will be happening in January. But in this training session, you'll be given what to expect, and the questions will be answered on your part. So over to you, Kathure. You have until 9:30.
Thank you very much. I hope you can all hear me.
Yes, we can, clearly.
Yes, we
can
can.
see my screen.
And yes,
Yes,
we
we
can see
can.
your screen.
Okay. So thank you once again. I'm excited to be part of this conversation. It's a timely conversation. Now, we thought Dr. Jackson has confirmed that we will not have Q&A sessions in between the presentations. So this slide has been overtaken by event.
Yeah, Kadri, yes, you can have control. You can decide to have it, no problem.
Oh,
You can just
okay.
see the time, yes, no matter what. Because I said they can
All
continue
right.
streaming the question, so we can still have it.
All right. Okay.
Yes.
So, all right. Thank you very much. So my session will be basically sharing with you what financiers want to see before they come on board. So, how do you begin to build a unique value proposition for your business? Governance is absolutely critical. We'll look at some of the finance and capital structures that are available. And then I think it's important for you to start thinking about exit, because this is the one thing as entrepreneurs, we probably, put it aside and say, we'll deal with that when the time comes. And then my colleague, Doreen, will be handling the fundraising roadmap, basically, just giving you a snapshot of what investors look for, what materials you need to prepare beforehand, the process itself, the pathway to a successful financial close, and all the requisite documents and activities. So that in a nutshell is what we're going to cover. I hope it's going to be exciting and engaging. So without further ado, let me delve into why it is important as entrepreneurs, as business owners. It is important to have a unique value proposition. And this is one of the prerequisites for investors. They want to know, what are you offering that is unique? So let me just minimize this video. All right. So what's a unique value proposition? I'll call it a UVP for just as we go along. So it's a statement that articulates why your offering is different, number one, and it is better than all the others in the market, and why your target audience should care. This statement actually covers the distinct benefit you provide, who it's for, and what it takes to make it uniquely valuable. And remember, this is to the consumers of your product and service. Okay, so when you're building a UVP, it is very important for you to know who is your target audience, who are your clients, who are you serving, what is their biggest pain point, what motivates their decision to buy your service and not to go to your competitor. Is it the cost? Do they trust you? Is it the speed? Is it innovative so they can do it from the comfort of their homes on a mobile or whatever? Okay. And then it's important to know what problem are you solving with this service that you're providing. So what challenge, what gaps, what inefficiencies are you addressing? Okay. How does the problem show up in your audience or your customers or clients' daily operations? And then you're going to describe what your solution is. After knowing who your audience is, what is the problem you're solving? So how are you solving this problem? And so what product or service or approach do you offer? And what outcome, what transformative outcome does it have in your audience? And then, because we are all in this world and we probably offer the same services, we produce the same goods. Think about banking. Banks are banks are banks, but there's a reason why you will stick to your bank. All right. There's a reason why you'll go to one bank and not the other. So why do you do so? So how do you, as a business owner, differentiate yourself that you can then attract these clients to yourself? And by knowing how you differentiate yourself, then you're able to quantify the tangible benefit that your customer is or your clients are receiving. It could be a higher return. It could be faster execution, so they have time to do other things. It could be you're seen to be a safety operator, so they don't have to worry about high risks. If it is a bank, they know their money is safe. Perhaps you're all about a social impact and they feel that you're making a difference in the society. All right. Now, it's important to just let you know there are tools for actually defining your company's value proposition, your unique value proposition. And these are tools you've actually interacted with. SWOT analysis. Yeah. What are your strengths? What are your weaknesses? Strengths and weaknesses are those facts that are in your control. What are the opportunities and threats? Opportunities are things that are out there that you have no control of, but you can take advantage of. What are the threats? What are those things that can affect your business adversely? Pestel, this is the political, I always get this name all over the place. So it's political, economic, socio-technological, environmental, and legal. So, scanning your environment. What competitive differentiation tools are you using? There are customer insight tools. There are value articulation tools and there are validation tools. Remember, I talked about the various steps of developing your UVP. And so you can use these tools. And these are tools that are available on the internet. These are tools you can actually buy of the internet. And in fact, some of the marketing companies that are out there and marketing individuals. And this is the value we are bringing as your partners, because we know all these service providers. So these tools are available for you to use to help you develop your unique value proposition. So how you use these tools to develop and validate your unique value proposition. First of all, they are tools to help you understand. So there are jobs to be done, empathy maps, customer journey maps, personas tools. And then there's tools to help you analyze. Yeah, you want to understand what's your competitive landscape, what strategic opportunities exist. The SWOTs, the PESTEL, the Porter's 5 forces, the Blue Ocean strategy, gap analysis, all these tools are actually there. And then you want to articulate, you want to shape and express that promise to your customers. And I'll share some of the UVPs of some of the leading brands, and you can begin to see how this all comes together. So the value articulation tools, they have tools like value proposition canvas, brand pyramid, unique selling proposition, golden circle. All these are tools that you can access from the internet, and certainly from your professionals. And then we talked about validating your UVP. You want to know, is it working? What resonates with your target clients and audience, and what actually delivers that true competitive edge? There are customer feedback tools, the Survey Monkeys, the Google Forms, interviews, focus groups, where you get unique insights into validating your UVP, or even tweaking it as necessary. Again, these are very high level points for your consideration and for you to ponder, so that we can take it to a more detailed discussion in January. So your UVP, it is usually a tagline, but it speaks volumes. One, it's short and memorable. It's easy to recall. Okay. Two, remember I started by saying a UVP actually emotionally connects with us as human beings. Remember, we're human beings, and we cannot separate emotions from the products and the services. We relate with these products emotionally. Remember, it is the value that your product or service is offering. Yeah. It is not really the product per se. So why does your company exist? Why do you do what you do? And then it has to be very distinctive. No one else can use that same statement credibly. In fact, if you did, you'd immediately be called and labeled a fraud. So just to give you a sneak peek of some of these UVPs, these are products you have definitely interacted with. Apple. Think different. Okay. What this really means is that Apple does not sell gadgets. It sells creativity, innovation, simplicity, its beautiful design, and its user experience. If any of you is using Apple products, I think this is relatable. Nike, just do it. Okay. It's not about sportswear and shoes. It's the inspiration, it's empowerment. Think about our marathon runner, Eliud Kipchoge. Think about Tiger Woods when he used to advertise the brand. So the UVP connects emotionally with the performance and the mindset. Yeah. When Kipchoge tells you no human is limited, and he's wearing a Nike, you can relate, because then it's an emotional connection. Let's talk about Netflix. Netflix has changed the way we interact with entertainment. Okay. See what's next. So it's focused on entertainment innovation and certainly personalized content delivery. Days of scheduled viewing, where you used to wait for a program to come or a movie to be shared, those days are gone. You decide what content, when you want to consume it. Spotify. How do you consume your music? It's music for everyone. It's simple. It focuses on accessibility and personalization. I certainly am a consumer of Spotify, and I design my lists. Uber. I can't imagine life without Uber. Okay. Their tagline is move the way you want. What does it mean? It means convenience. It means control. It's empowerment through seamless mobility everywhere, practically everywhere in the world. So just to start giving you an idea of how are you connecting with your clients. Now, the other key factor that you must consider before engaging with, before I move away from the UVP, the importance of a UVP is that it actually builds into the valuation of your business, because you're demonstrating there's a unique there is something unique about your business that is not gotten from somewhere. And for that reason, when a valuation is done before investors come in, you're able to command a premium, for example. If it is borrowing, when you prepare your business plan and your bankable proposals, when you take it to your lenders, they're seeing there's something unique about this business. And this is a business we're prepared to stand behind. So governance is absolutely critical. In fact, I think this one should have been the first one, but here we are. So governance is the system of rules, practices, and processes by which a company is directed and controlled. It defines how power and accountability are distributed among the companies or an entity's key stakeholder. That is the board of directors, management, shareholders, and other stakeholders in your ecosystem, your customers, taxman, laws, regulations, business partners, and so on. And this is all to ensure that the company is run ethically and efficiently, and certainly in the best interests of everybody. So there are governing principles for corporate governance. There has to be accountability, so clear roles and responsibilities. There's transparency. That means you're openly disclosing your performance and decision-making processes. We're not talking about publishing your financials unless you're a regulated entity like a bank, in which case there are disclosure requirements. We're talking within your business, you have proper disclosure of performance metrics and decision-making processes. The way you relate with all the stakeholders is fair, it's equitable, not equal, but equitable. And then there are responsibilities for compliance with the laws and regulations, okay? And ensuring that the leadership applies the ethical standards. And then it is important for independence, so we avoid conflict of interest and so on and so forth. And I'll just unpack that in a few short slides. So when we look at governance, we want to see what is your corporate and organizational structure. Corporate is how is your business owned? Do you have a holding company? Do you have, is it an incorporated limited liability partnership? Is it a sole proprietor? And even so, what is the structure? Then you want to talk about the organization structure. How is this managed? Do you have a management team? How are roles and responsibilities shared across to ensure the common purpose of the organization is then met? Okay. It is very important for you to consider, a board of directors or a board of advisors, and very specifically independent minds. Independent means they are not shareholders in the business, and to be honest, they are guided by ethical principles and best governance principles. Best governance principles means that they want the organization to succeed. And if the organization does not succeed, it also harms them reputationally. So you can see how important this is. I'm sure you've seen directors who've been hauled to court for companies that have had misdemeanors and have committed fraud, and they're actually in court. So personally, you're liable. So if you look at the corporate and organizational structures, we are looking at who is your board, who are your board members, what sort of reputation do they have in the market? And then you also want to see how is your company managed? Do you have a proper management structure? Risk is absolutely critical, okay? It is important for you as part of your governance structure to ensure that you're able to identify, to measure, and to mitigate the risks that beset our businesses, be it financial, be it operational, legal, technology. Business is being disrupted by technology. AI is here with us. So are we taking advantage of that, or is it disrupting our businesses? And this is typically assessed using your policies and your control framework. Controls help you to capture any lapses in the risks. Stakeholders, how do you manage your stakeholders? Who are your stakeholders? Your shareholders, your employees, your customers, government, regulators, partners. Okay, how do you manage those relationships? And then today, if you're not doing sustainable business, there's a big question mark. So have you embedded your ESG, the ESG principles into how you operate your company? Okay. There are some financiers who will not touch you if you're using child labor. If there's a social angle that's not being met, for instance, a poverty alleviation through job creation, and there are metrics to measure these things. And these are this is stuff I have actually worked on in my long career. And the way we engage here is making sure there's a disclosure framework, be it audited financial statements, annual general meetings for your shareholders, extraordinary general meetings for to discuss special matters, your ESG reports, and their reporting frameworks that are out there. Now, it would be remiss of me not to talk about family-owned businesses, because what I've presented, the picture I've painted, is really the governance framework for your conventional business. But most of our businesses, especially the SME businesses, are family-owned businesses. And there are dynamics and nuances that cannot be ignored. And I think it's important for me to talk about this. So this framework actually balances the family, the ownership, and the business interests. Okay, so you must combine your family values, your ownership interest, and also think about professional management. Even if you're an owner manager, for instance, do you have a contract with the organization? Are you getting a salary from your organization? Okay. Effective governance is very important for family-owned businesses to ensure continuity, accountability, and certainly long-term success. We've seen some very prominent family-owned businesses actually go down, primarily on account of governance lapses. So suffice to say, governance for family businesses is absolutely critical because of preserving the legacy and going into the business as a family. So some of the challenges you will see with families is, there's an overlap of roles. Who does what? And so here, think about having defined roles, and that can be achieved through a family charter. Excuse me, I'll talk about that in a few slides. Succession disputes. How is this business, going into the future? So these discussions need to start early. They need to be structured, and there are experts to support you on that. The lack of professionalism. This means your business is pretty much, you don't separate your business from your personal life, okay? And perhaps one way to do this, introduce independent advisors and directors. It could be somebody you sound ideas off of. And then we cannot have family-owned businesses where there are no conflicts, okay? Family conflicts, especially where businesses are owned, and you've seen businesses like Tuskys, the sort of conflicts are played out in the public. Before they go into the public, before they go into the courts, what mediation protocols do you have? Do you have a family council that deals with these problems? And then there's short-termism, yeah? Most businesses, especially our businesses, tend to end when the owner exits the scene for whatever reason. So to perpetuate these businesses, have you shared your long-term vision? I think I've already talked about that: transparency, meritocracy, accountability, continuity, independence. Let's talk about some of the governance structures we've seen for family-owned businesses. So it is important for you to consider having a family governance structure, and this manages your family relationships and your legacy. Granted, decisions tend to be made around a dinner table, yeah? So what is your family assembly? Is it bringing all the relevant members together? Do you have a family council? Yeah. who represents the family in business matters? Do you have a constitution, a family constitution? This defines your values, your policies, how the business is going to be run into perpetuity. And then you want to look at the next generation committee, yeah? To the extent that it's becoming apparent that our children do not even want to take over our businesses, then it is important to start thinking about this, because you do not want a business to die with you just because your children are not interested in the business. So how do we ensure these businesses live beyond us? And then there's the ownership governance, which helps you to define your rights as a shareholder, your responsibilities, and certainly align with your long-term goal. This is important. Back to the corporate governance structure. Do you have a board of directors, even as a family, who provides the strategic oversight and approval policies? Remember, we talked about risk management and using policies to manage those risks. As part of the board, do you have committees that hold you in check? Do you have an audit and risk committee? Do you have an HR and remuneration committee, just to avoid these antagonistic outcomes? Okay. It is important to professionalize your management. And if you look at the businesses that have really succeeded, let me talk about NCBA. NCBA is a family-owned business by all means. It's owned by two families, but look at what they have done. They've actually professionalized the management team. They have professional CEO, they have a professional executive committee. I was part of that leadership. And then we were given the responsibility to execute the strategy, okay? Now, if I look at the corporate business governance, again, these are just iterations for you to consider as you put together your governance structure. And I think I've actually replicated that. But really, for corporate and governance is the system of checks and balances that help you as a family to separate your ownership, the emotion that comes with that, with the business, and the outcomes that need to be addressed by this structure. So governance is absolutely key. When financiers come, they want to see what is your governance structure. Now we can quickly talk about what this capital landscape looks like, and some of the funding instruments, some of which I know you're very clear about. But capital extends beyond just cash, okay? Capital is the money or other assets a company uses to operate and grow. And the types of capital, we have financial capital, and this is the cash that you use in the business. It can be debt, it will be equity. I'll talk about that a little bit more. There's a physical or tangible capital. These are your assets, physical assets, your machinery, your buildings, equipment, which are used to produce the goods and services. There's a very important asset that or capital that we tend to overlook, and this is a human capital, without which you would not be able to run these machines, you'd not be able to offer this service. So really, it is important as a business to start thinking about what human capital complement do you have? And there's an economic value to it. It is your skills, your worker skills. It's the knowledge and the experience. The beauty about this, it can be enhanced through training, education, employee value propositions. And these are things we can unpack in more details. This is absolutely important because when these financiers come on board, they want to see who is doing what, do they have the requisite skills and the independence to do so. And then there's the intangible capital. These are the non-physical assets that your business owns, your brand, your knowledge, intellectual property, yeah, your copyrights, and so on, your reputation. This provides an economic value to the business. And I can tell you, when you carry out a business valuation using, the various methodologies such as discounted cash flow and so on, you begin to understand how significant all these other, intangible and human capital all plays out. That is why you'll hear about a brand valuation as a standalone valuation. What is the value of this brand? When we say Coca-Cola, if we are selling shares of Coca-Cola, for instance, yeah, what is the brand value? So even for your business, it is important to know. And remember, the UVP, the unique value proposition, is all building into identifying your intangible capital. I think for financial capital, this is the easier discussion to have. But you know about debt and equity, you know about term loans, the overdrafts, asset financing. You have bonds where you come to the public and borrow, for instance, family bank bond. There are government funds that ostensibly support, for instance, youth, women. There are also development finance institutions like AFDB, but these ones tend to work with extremely large organizations. And you will find they typically work with other intermediaries like banks. They provide significant funding so that this funding can be availed to other borrowers. And then there's the equity, your owner's equity. These are the funds you inject as an entrepreneur or as from the family. Retained earnings, if the business is making money, you can reinvest it back instead of distributing it as dividends. And this can be used to support a business growth. And then there's other investors, the private equity, venture capital, angel investors. PEs are typically those funds that invest in more mature SMEs. Venture capital are those investors who look at what they deem to be growth companies or innovative businesses. You've seen a lot of that money chasing digital businesses. And then the angels are those wealthy individuals, usually philanthropy, who invest very, very early stage. So you're thinking about an idea, but you need to test the idea, proof of use, and so on. These are the sort of investors who come on board. There are hybrid capitals. There are capital, that says we'll come in, but we are debt, but we could be equity in the future based on some conversion options, preference shares who come before normal equity. And then there's convertible bonds, which say we'll give you money, but at a certain time, based on 1, 2, 3 conditions, we are going to convert into shares. And these are the prices that this will be done. And then there's other forms of funding, crowdfunding, okay? Donation-based funding, like GoFundMe for social needs, medical, and so on. In fact, in the CMA, we have crowdfunding regulations and so on. So there's different, avenues for you to think about. Digital finance, which is typically for emergency liquidity. You've run out of money in the petrol station, you need to fuel your car, you fuliza. Islamic products for those who are who want to not use the conventional funding. There are Islamic products, and we do have Islamic banks in Kenya that provide this kind of funding. Impact, I talked about ESG. That has become the new kid, the hottest kid on the block, and this is important. These guys want to measure the impact, really. What jobs have you created? How are you supporting women and youth? Are you depleting the environment while doing business and so on? And then there's an interesting one, and I'm actually in the process of designing one, private debt funds. These are capital markets products. It's a pooled investment that sources capital from institutionals and then lends to private companies. Now, just to give you a sneak peek, when you talk about funding, it is important to ensure, the funding matches the venture, okay? So internal finance, your owner savings, your retained earnings, that is typically your early stage. That is the money you invest as an owner. You want to start your salon, the initial equipment, the fit out. That is money you probably get from your pocket. Unlikely a bank will fund if they can't see cash flows. And then there's debt finance, which you interact with. This is from the banks, this is from microfinance institutions, from the SACCOs. They typically lend this for working capital and asset acquisition. I talked about equity finance. They are angels, your VCs, your private equity, and these ones tend to fund various elements, growth, expansion, and so on. Development finance, alternative finance, and I've talked about hybrid and impact capital. Now, when you're looking at funding, it's absolutely critical for you to apply what we call the matching principle. And what this does, it helps you to align the funding in terms of the maturity, the structure, the costing, with the nature and the duration of the assets of the projects that are being funded. So let's talk about tenor matching. So the principle is that you need to match your long-term assets to long-term funding. Excuse me. If you're buying property, plant, expanding into a new market, geographical market, if you start using working capital, you're using overdrafts, you will soon run into problems. If you're buying stock that you're turning over in 90 days, then for you to take a loan, a 5-year loan, to buy stock that you're turning over in 90 days, then there's a problem because you're basically absorbing a significant cost for a benefit that is not commensurate. So it is important for you to match your tenor to the asset, and the rationale is that it helps you to avoid liquidity risk. Yeah, and I think I've given you examples about that. It is important to match your currency to the cash flows that you receive. What do I mean? A lot of us tend to think if I can get funding in US dollars, yeah, because they would typically come at a single interest rate, for instance, 7%, 8%, it will end up being cheaper. But this is the trap. If you recall last year, the USD reached 167 shillings to the Kenya shilling. So if you had borrowed $1,000, for example, yeah, at 167, and so you have to carry that in your balance sheet. Or when you carry assets and liabilities in your balance sheet, you have to price them at the prevailing price. So that loan would have to be converted at 167 shillings. Today, that dollar is at 130, for instance. Okay, so to avoid the vagaries of currency mismatch, it is important to borrow in the same currency. Now, if you're an exporter earning in dollars, it is very well to borrow in dollars because your cash flows will be in dollars. So you're not carrying any currency risk. Okay. Cash flow matching is important because if they are structured payments, so you're purchasing a factory and you're saying, I need money for or rather assets to put up a factory. I need 5-year money, yeah. Now, it is important for you to structure when you're discussing those structures to confirm that you are able to start paying back the loan when the cash flows start coming, i.e. when your factory starts producing. And that is why it is important to start discussing factors to do with a grace period on your principal, okay? So it helps you to service your debt without strain, okay? It is important for you to assess the cost versus the return. What is your return on investment? Whatever you do, always make sure you know what your return on investment is. And for that reason, it should exceed the cost of funding. So if you're buying an asset and you're paying 15%, if the return on that investment is 12%, you're literally losing money. Okay, and there are tools to help you do that. IRR, simple spreadsheets in Excel, net present value, payback period, discounted payback period, which looks at discounted future cash flows. And then, of course, it's important to align the purpose. So if you're buying asset finance, if you're using asset finance to buy vehicles, then those vehicles need to be generating dedicated streams. Income streams. So it helps to improve efficiency and accountability. So we're talking about logistics. If you're buying a logistic truck and you've taken asset finance to purchase that truck, how much revenue is that truck generating vis-a-vis the financing cost? Now, I did talk about when you come into the business, it is important for you to have an idea of how you exit. Yeah. I know this sort of preempts the next discussion, which my colleague will talk through, but I think it's important for you to think about exit. And this should always be at the back of your mind as an owner of the business. So an exit strategy refers to a process through which investors, founders, financiers, how they realize return and how they withdraw the capital from the business. Why is it important? If you're a founder, it is important for you to realize some of the value you've created over time. Okay? It also helps to signal that the business is now mature, that you can begin to attract investors, and my colleague will talk about that. Perhaps you're looking at a transition of ownership. So how do you exit? I can tell you it's a prerequisite for private equity, for angels and venture capital. They always exit because their money has to revolve and rotate through other opportunities. So I cannot underscore or what's the word? I cannot, I think it's very important. When you get into a venture, it is very, very clear. It should be very clear. How do you exit? And I'm not talking about a complete exit, but how do you realize some value? So when you're planning the exit, yeah, there are some key considerations for you to consider. What is the objective for the exit? What is the goal? What is the timing? What is the intent of that exit? Are you looking to exit fully? We have seen some family-owned businesses where the founders have, become old and are not, and they are not able to continue running the businesses. So they may want to consider a full exit if their children are not interested, or so and so on. Some say, look, I have built this business, I have created this value. I want to stay on and provide leadership, institutional memory, and so on. And in any case, in some institutions, like private equity, they would ask for a founder to stay, just for that extra comfort. It is important to think about what is your business worth. And in fact, what drives value in your business. We talked about the unique value proposition. Here it comes again. And this helps to create a maximum value for your business. And there's others. It is important for you to choose the right exit. Will it be a trade sale? Is it going to be a PE, a private equity, or those venture capitals? Is it going to be an initial public offer? I mean, we're talking about Kenya Pipeline right now. It's the hottest thing on the IPO desk. Is it going to be a management buyout, or will you transfer this to a family? It is important to think about succession. I talked about that. Even with the family governance structure, you need to start preparing successors to ensure there's leadership and there's continuity. Okay. Optimize your legal and tax structures. This is very, very important. Some of the owners are now transferring their ownership into trusts, They are transferring operating companies' ownership from themselves into a holding company, and all they do is now provide oversight and then employ a professional management team. Okay. It is important for you to be ready. Readiness, again, it speaks to the whole governance structures. Do you have audited financials? Do you have an efficient operation? Where are your manuals? Are you due diligence ready? Do you have data rooms? And so on and so forth. And then who are your stakeholders? These need to be managed very, very carefully. Certainly, confidentiality is key. And this is especially so for IPOs, for any public sale, anything that is happening in the public domain. And I dare say for what we call public interest companies. Public interest companies are those that serve a wide range of, a wide cross-section of customers. If you think about not a Nakumat, Naivas. And Naivas is a public, is an entity. It's public in the sense that it serves a very wide cross-section. And so that's why you'll find that, anything that is negative finds its way into the social media and so on. And also you can use the social media for positive interaction. And then once you exit, whether it's partial or, 100%, are you going to exit and then soon after that start looking for another venture to invest in? Or will you have your money invested for you by a professional investment company? There are issues for you to consider. You may sign non-compete clauses, so you cannot go and do something similar. Are you going to assume an advisory role? Are you going to be a philanthropist? Are you going to provide mentorship? Manu Chandaria, I say Bill Gates very carefully, but Bill Gates actually exited his business, running it substantially, and is now more into philanthropy, if that's what they call it. Now, some of the exit mechanisms you want to think about, there are trade sales. This is where you sell your business to a strategic buyer in the same or a related industry. And just to give you an example, when Brookside Dairy sold, I think 40% stake it was, to Danone of France. These are both in milk processing. There's a secondary sale. This is where the sale of a stake to another investor. It's usually done among the PEs and so on. So if you look at the Java transaction, Java, the coffee house, has changed hands quite a few times, and it's all between private equity firms. IPO, initial public offer. This is listed on the stock exchange, and it's usually for participation by public investors. It's a long route to do so. It's typically done by mature firms and maybe some PEs who are looking to exit. The last IPO was Safaricom in 06, and I did talk about KPC, which is currently underway. You can get your management to buy you out. This is where management buys out investors, and it's usually done in private firms. I think you've seen what has happened with Kestrel Capital, which is a stockbroker. It has been acquired by management, so they are going to own that and run the business. There are share buybacks and redemption where the company decides it's going to buy back its shares. There's EABL, East Africa Breweries. There was Nation Media that went on for quite a while. And it can be a way of even delisting from the stock exchange. You can merge and acquire a business, and the founder can exit as part of the merged entity, okay? So when Facebook acquired Instagram in 2012, notice I've not put NCBA here. As much as it was a merger, the shareholders remained in their relative holdings in the merged entity. So that is why I have not put that example there. Unfortunately, some companies are liquidated, they can wind up, and this means that assets are sold as separable items, and then the proceeds are distributed thereafter. Usually used in insolvency cases, this is not one option we want to see. And then in some instances, you can earn out and partially exit. This is typically used by investors such as PEs and the venture capital. And one example is when Apple acquired Beats by Dre. There was an outright purchase price, but there was a deferred consideration. Deferred means this is a price that will be paid in the future subject to certain conditions being met. So that is what I wanted to lay as the background to the next discussion that Doreen will be taking you through. And I think, Jackson, in the interest of continuity and flow, I would suggest we just continue and then take questions right at the end. If that works. Yes, yes.
Yes, yes. Thank you so
Thank
much
you.
for that
Yeah.
elaborate discussion and for taking us through that. As participants, you are aware, this is just the beginning of the training. We wanted to tell you what you expect. We didn't want to make it a simple training to go directly and tell you, these are the people you need to contact if you want to import, to export. We needed to give you the outlay from where to expect, from acquiring the capital, what are the risks, and what do you need to look out for once your business is thriving, and to make sure that it's in existence beyond now and even beyond your children, that is in terms of future generations. So Kature, thank you so much. For the Q&A, participants, please continue using the chat box. We'll try to squeeze in some 10 minutes at the end for Q&A at around 10:20. But as of now, I wish to invite Doreen, who will come in now at 9:35. And Doreen, you have approximately around 50 minutes. You'll be able to stop at around 10:15 so that we use the rest 15 minutes for Q&A and giving the people the way forward. So for now, the floor is yours. Thank you so much.
Thank you, Jackson. And also thank you, Kathure, for that great introduction. It's very rich, but very well delivered. So I'll share my screen. Let me try and make sure that you're able to see it clearly. Let me know, are you able to see a full screen?
Yes, yes, we are. Very clear.
Yes, yes.
Right, great. So just following on from Kathure, this section is going to talk about the practical execution of raising capital in the market. So in this session, I'll talk about what investors look for. Kathure has covered some of this, so she's built the fundamental knowledge that you need to have before progressing into the actual execution of looking for capital. So we look at what it looks like what investors look for when analyzing various investment opportunities. So I won't go into too much depth into equity and debt. I'm sure we are all aware what equity is and what debt is. So for the purposes of this session, I'll only focus on equity and debt. I know Kathure mentioned, other types of capital structures. There's mezz debt, there's quasi equity, there's very many other structures, but for the purposes of this session, I'll get into equity debt. Once we have a follow-up class, then we can go deeper into the various capital structures. So let's discuss equity investors and their thinking. So if you think about equity, this is someone who wants shares in your business. And what is their goal? It's always important to understand when you're having equity discussions with potential funders, it's always important to understand what is their end goal. And as Kathure mentioned, if you look at any angels or VCs or private VCs, venture capital funds, PEs, private equity funds, their goal is always to exit. And that's why Kathure really emphasized on the exit, which is very different from African businesses. When African businesses, a lot of us start businesses, we started to hold on to it and to control it with everything it is that we have, rather than have an exit strategy. And it's important how you get into a business, because if you have an exit strategy, it means you're thinking about, how do I grow this business to the point where I'm able to generate as much as I can out of it, as opposed to the typical African entrepreneur mentality, which is I want to grow this business so that it can feed me and it can feed my family. and so that I can be comfortable. So you see, there's a different way of thinking, and it's very important to be able to understand that way of thinking, because if you're thinking in 5 years' time, I want this business to be I want it to be significantly big so that someone else can come in and grow it to another level and give me 10 times what I paid for it. So the thinking is very different. So when you're speaking to an equity investor, they are thinking, what do we need to do in this business to grow it to be 10 times more? So this is different from, sorry, I should have had another slide where I talk about debt investors. So let me go back to this. So equity investors are thinking about the future. So they want to invest in your vision. So an equity investor is investing in your vision. They're investing in your strategy, and they're investing in the potential of your business. You see, they're looking at the potential of your business. Of course, you have to have something to show for it, but largely they're looking at the potential of your business. However, when it comes to a debt funder, they're looking at, can I get my money back? That is all they're concerned about. Can I get my money back? And so the thinking is different. And so an equity funder looks forward, a debt funder typically looks backward. And so let's get into equity investors. So what do equity funders look for? So Kathure mentioned the UVP, the unique value proposition, and that is key. That is key. Before you even discuss shareholding, you discuss, this is how much money I want to raise. This is what, before you start discussing anything else, your UVP must be absolutely clear. You must have a good understanding of the problem, and you must have a good understanding of the solution. And what does that mean? It means, I don't know how many of you in this session are importers or exporters, but it is, you have, the problem might be, there's a high demand for, let's say, avocado from China. That's actually a real case. China imports a lot of avocado from various countries, Kenya being one of them. And so, how do you solve this problem? There's a demand from China that wants avocados. I'm able to provide a solution. Actually, the whole world wants avocados, right? And so how are you able to ensure that your solution is able to meet the global demand? For your solution to be able to meet the global demand, it must be quality. It must be, the quality must meet the global demand. The quantity must meet the global demand, and your costing and your pricing must meet the global demand. So you're able to create a solution, a proper solution that is in line with the problem. So what else do equity funders look for? They look at your ability to scale. So for example, remember I had mentioned that an equity funder is looking at, is your business able to grow 10 times? In fact, there's an important terminology that's used in the industry that we're in. They call it, can I 10x this investment? 10x means essentially that, can I exit this investment and make 10 times what I've put in? So every angel, VC, especially venture capital funds, private equity are not so aggressive, but a typical venture capital fund is looking at, can I 10x or 20x my investment in 5 years? And so for me to be able to exit at a high fee, at a high valuation, it means the business must grow 10 times. You see, I can't ask someone to pay 10 times for a business and it's the same as revenue when it started. If in 10 years' time, let's say year 1, I was earning 1 million shillings in revenue, and then by year 10, I'm earning 5 million shillings in revenue, I can't ask for 10 times the amount of that business because the business has not grown 10 times, you see. And so capacity to scale, an equity investor is looking at, how can this business grow 10 times to what it is now? And so what systems and structures do you need to have in place for your business to grow 10 times? You need to have the right teams. I know Kathure covered this earlier. You need to have the right systems and structures. You need to have the right go-to-market strategy. There are very many things that you need to have to ensure that you're able to scale your business properly. The other thing that they look at with the capacity to scale is they look at the market. What's the size of the market? Of course, I was using, and let me stick to my avocado example, just going forward. Avocado global exports is a significant market. So in terms of how big is the market, there's something called the TAM, the total addressable market. The total addressable market is huge. So there, tick, okay. The next thing that the investor will ask is, okay, fine, the market is huge, we get it, the demand is a lot of demand, from Brazil and all of these countries that export avocado, you know, how is your business positioned to export avocado? You know, so you must have the systems, the structures, and the teams to be able to export quality avocado at the right price. So let's move on to strong unit economics. So the other thing that equity funders look for is strong unit economics. So what does unit economics means? Unit economics goes further than, oh, my sales are going up, or my costs are going down, or I'm profitable, or these are my profit margins. Unit economics are very important because you must understand the profitability on a unit basis. Let's take an example. So let's stick to the avocados. So how do you get to a unit cost? So how you get to a unit cost is, let me see, just give you a background before getting into this example. How you get into, how you calculate unit cost is, let's say you're exporting a container of avocados. I don't know, let's, for lack of, because I don't really know what it's like to export avocados. Let's assume to fill a container, it's the weight of the container will be 20 tons. So 20,000 kilograms. So if you're exporting a container of avocados, assuming that, you know, the weight of the container is 20 tons, you look at what is the cost of these 20 tons. And then in these 20 tons, roughly how many avocados have I been able to export in 20 tons? And then you divide it by the number of avocados. So for this example, I've kept it very simple. So I have two scenarios, and this is I'm trying to explain the importance of unit costs. So in this scenario, in the first scenario, you're using rented trucks to get the avocados from the farmers to the freight, to the cargo ship. And in the second example, I assume that you're not renting trucks, you own the trucks. Just a disclaimer, these numbers are not accurate, they're just for the purposes of an example. So assuming it costs you 10 shillings to buy one avocado, assuming that the cost of you to buy one avocado is 10 shillings, and then we assume that if you're renting the trucks, the logistic cost per avocado to get to the cargo ship is 30 shillings, right? We assume that then we therefore come up with a total amount of 40 shillings. So it costs you 10 shillings to buy the avocado. It costs you 30 shillings to get the avocado to the cargo ship. That's 40 shillings. So in this case, we assume FOB price of 50 shillings, which means that you've not included the shipping costs from the port to the destination. We assume an FOB price of 50 shillings, which means that you have a profit of 10 shillings. So the gross margin is the profit divided by the revenue. That's what the gross margin is. So in this example, the gross margin is 20%. So the importance of unit economics is, your executive team sits down and says, okay, we are paying 30 shillings per avocado. If we own our own trucks, what does this look like? So in the second example, the purchase cost doesn't change. It still remains 10 shillings. You pay 10 shillings to the farmer. But then now that you own your own trucks, right, the logistic costs come down by half. And in this example, it comes down to 15 shillings, which means your total cost base is now at 25 shillings. If you're still selling it at an FOB price of 50 shillings, it essentially means that your profit per unit is 25 shillings, which means your gross margin is going to go up 50%. So it's important to understand how the unit economics affects us, on a unit level. And so what this means is, if you're able to say that if we own our own trucks and our costs are able to go down by half, it means that we have additional profit. So remember, unless you're sitting on a lot of cash, chances are you'll probably have to borrow money to buy these trucks. And so this analysis allows you then to go back and say, okay, our costs have gone down by 15 shillings. Our costs have gone down by half. This means it allows us, it gives us additional profit so that we can be able to purchase our own trucks. And that additional profit will then tell you, if we use this additional profit to purchase our own trucks, then we are able to pay back our trucks over a certain period. And that's the importance of unit economics. And we'll get deeper into unit economics during the course. So what else do equity funders look for? They look at, how do you compare to your competition? So yes, you can argue that, when you're pitching to an investor, you can say, look, yes, the global avocado market is high There's so much demand. There's this demand from EU. There's this demand from the US. There's this much demand from China. There's this much demand from, wherever, there's demand from very many areas. But then the investor will come back and ask you, great, I appreciate that the total addressable market is significantly huge. I appreciate that you're also in this industry, but what is your competitor doing? And so it's very important for you, and this is part of the UVP, which is very, very critical. How do you compare to your competition? Because once your investor is able to look at your numbers and see, this is a profitable business, they're going to, what stops them from going to your competitors and saying, who is doing this better so I can fund them? So your unique value proposition also must include, how are you doing it better? How are you doing it better to your competitors? So if you, in whatever industry that you're in, it is always important to understand who are the competitors in the market. Don't keep your head in the sand. Understand who your competitors are in the market. Understand how they're providing their solutions, how they're providing, and even for the successful ones, understand what makes their business successful. In fact, the best way to start a business, in my view, is when you're working for, let's say you want to become an avocado exporter. In my view, the best way to start a business is actually to have worked in an avocado export company. And when you work in an avocado export company, you're able to see the full value chain end to end. You're able to see what it takes to acquire a new client, what it takes to acquire different categories of clients, what it takes to acquire a high-paying client, low client. What does it take to acquire these clients? What systems and structures do you need to have in place? What team members do you need to have in place? What logistics, what market networks do you need to have in place for you to be able to acquire, quality avocado consistently, to be able to supply to your client? It helps you understand so many dynamics. The other thing about working in an industry before moving to it on your own, it also helps you understand at some point you should be like, if I had my own business, this is what I do differently. This is what I do differently. Here they treat their staff badly. And because they treat their staff badly, their staff people are stealing from them constantly or are underperforming. If I had my own company, I'd treat my staff well, I'd pay them well. And then this is the performance would then result in, higher efficiency, resulting in higher numbers, And so it's very important for you to think through, how are you doing it better than the competition? So in this example, you've been working for the competition. So it's very easy for you to see their strengths and their weaknesses and the opportunities that they're not being able to see. And I think Kathuri talked about this in, analysis. You're able to understand what is the strengths, what are the weaknesses of the competition, how can I be better? So even as a business person, always be thinking, how can I be better? How can I be better than the rest? It's not just about survival. And a lot of African entrepreneurs sometimes can get stuck in the survival cycle on, how do I pay salaries? How do I pay bills? How do I pay bills? You're not focused on, how can I be better? So what else do equity funders look for? They look for, is your business growing? And so it's very easy to say, especially for startups or people who have never entered the industry before, it's very easy to go to an investor and say, look, I have the numbers of, if I export avocado, I can do 20 tons. This is the profits that I can make. This is how much I can make. And Excel sheet forecasts are fantastic because you can grow as fast as you want. You can even do 20 containers on Excel. You can do 50 containers on Excel. But like we say in Kenya, vitu kwa ground, they're usually very different, from your Excel sheet. And so even as you're pushing a funder, you must have some form of proof of concept. Yeah. So you need to have, if you're going to someone and I'll stick to the avocado just throughout this, just to make it simpler. You're going to someone and you say, look, I want to export avocado. They'll ask you, how much avocado have you exported before? Because there are many things that you don't know. You think you because you have an Excel sheet, you think you understand the market, unless you've actually done it, or have worked in an industry where someone has done it within a competitor, you really don't know. And so equity funder would like to say, okay, fine, you have this idea, you have, big growth forecasts. What have you done so far? What have you achieved so far? And it's very hard to say that, look, I've not been able to grow my business, but somehow if you give me money, I'll grow 10 times. And that could be true. Maybe the reason why you haven't been able to grow your business is because you haven't had access to capital. But then sometimes that is not the only reason why businesses aren't able to grow. Even if you haven't had access to capital, your business should be growing organically. Like even with the avocado business, you're getting a profit. That profit should be reinvested into the business. And so even as much as you're not able to grow faster than you could have if you had capital, you're still able to grow because you're reinvesting. So there must be some level of business growth. And this is very important for entrepreneurs. Don't eat your profits. A survival mentality must come to an end. It's not just about paying bills and paying all of this. You have to grow. You have to grow. And because an equity funder will always want to see that you are in fact growing. The other thing they want to see is you have actual records of growth. And this is where, a lot of businesses, unfortunately, aren't so great, that they don't keep good records. So you're growing, but it's very hard. The only way you can explain or demonstrate to another party that you're growing is through numbers. And your numbers, must be accurate. So let's move on to debt investors. And so, like I explained earlier, debt investors, they're not so much interested in your vision or all of that. I mean, it's very important that they understand your strategy, but by and large, they just need to be convinced that you're able to pay them back, as opposed to an equity investor who's thinking about your future. How fast can you grow? And even some equity investors, let me just go back to equity investors. They are so consumed with how big your business can grow. It is bigger than you. They don't really care about you. So even if you look at Steve Jobs and how he was ousted from Apple, I think in the 90s, it's because the investors, the equity investors, it's not about you. If you as the CEO or the founder become a hindrance to the business growth, they will remove you to just make sure that the business grows. So always have that at the back of your mind, even when thinking through equity. So let's now move on to debt. Debt providers pretty much just want their money back. They just need to understand how much can you pay and when can you finish paying. That's their main issue. So for you to be able to demonstrate to a debt funder that you're able to pay them back, you must have a strong client book. What does a strong client book mean? It means that you don't have one client. One client is not a strong client book. Even if this client is bringing 100 million shillings every month, you actually have what is called key client risk. You have your business is high risk, because if 100 million or if 100% of your revenue is coming from one client, the day that client decides to go to someone else, that's it. That's the end of your business. And so you become a high risk client. Instead of having one client that's able to give you a $1 million contract, sometimes it's even better in terms of raising debt to identify, 10 clients that you can work with. Let each of them give you $100,000, $100,000, to get to your $1 million revenue target, you see, or even 100,000 shillings or whatever it is, 10,000 shillings. It's better for you to have clients that are diverse, that are consistently paying you back, So the other thing that they look at is, what does your client book look like? If it's very slim, then you're high risk. If you have many clients, then you're lower risk, because the debt funder is very concerned about risk. And so they look at your client book and they'll say, okay, fine, this person has 10, 20 clients. Great. How often do these clients pay? If your clients are not paying well, that is also risk. In fact, even for you as a business owner, if you have clients that are not paying on time, that is a risk to you, because it's better for you to work with clients who are able to pay on time. In fact, what I'd say is, even with the debt funder, when they're looking at your clients, they look at something called your receivables or the payables. Your receivables are the amounts of money that you're expecting to come into your business. Your payables are the amount of money that you pay to your creditors. And so the difference between your receivables and your payables is called, it's called the working capital gap. So by the time you pay money, sorry, let me just go back slightly. It is better for you to receive money earlier and pay money later. So for a lot of businesses, for example, let me talk about the export business. By the time you're going to buy an avocado from a farmer, they're not going to wait 90 days for you to pay them. A lot of the times they'll want their money upfront or within a few days. Very few farmers are willing to give you avocados on credit. And so you'll need to buy the avocados beforehand. But by the time you identify all of these avocados from all of these farmers, you put it in a container, you send it to the client, there's a period between you paying and you receiving money from the client. And that is called it's now called the working capital cycle. And so it's very important for you to understand what that is. And that's what debt funders would look like. They'd be very keen to understand what your working capital cycle looks like. Yeah. And this is just for businesses that have stock that they're turning around. And they'd be able to look at who your clients are and whether they pay on time. So if you have many clients and they're paying on time and they're paying consistently, then you pose a lower risk. The other thing that debt funders would look for is good cost control. How are you managing your costs? It's very easy to run a business where you're turning over, large amounts of revenue. Sorry, just one second. Let me sip some water so I can continue talking. It's very easy to get caught up in money coming in and out of your account and not really understanding what your costs are. And even as a consultant, I've seen this with many businesses. You have cash coming in, constantly cash. So it looks like you have money coming into the account, but you're not cognizant of the costs that are leaving your account. And so what a debt provider is going to look for is that you have good cost control. They want to look at how well do you manage the costs of your business. And how well you manage the cost of your business determine your profitability. And remember, you can't pay debt on money that you can't pay loans with money that you don't have. If you're not able to manage your cost, assuming that your revenue is coming in, if you're not able to manage your cost well, you're not able to pay your debt. And so the debt funder would be able to see, this is your revenue, this is your cost. Okay, so this is how much this person has available to pay debt. They look at a metric that we call EBITDA. It's earnings before interest, tax, depreciation, and amortization. And that is the money that your business is able to have to pay the debt. And so the other thing a debt funder would look at is your debt history. Do you have current debts on your book? How have you been paying your debt historically? Of course, your banks would look at things like, are you listed on the CRB? Even other private funders would look at, are you listed on the CRB? So it's always good to, as far as you can, some things are out of our control, as far as you can, to try and not be listed. And if you're listed, to just try and get out of it primarily. So if you have debts already and you're trying to raise additional debt, sometimes it's good to also consider someone who's able to come in and restructure your current debt book. So let's say you have, a debt from INM, then you have a debt from, a loan shark, a debt from a family member. Sometimes it's good to find someone who's able to consolidate that debt, pay off your other debt funders, and then consolidate it and maybe add more so that your business can continue to grow. And so the other thing that they look at is, how have you managed debt historically? If you have a history of not paying people back on time or not paying other debt funders back on time, then of course it's going to be harder for you to raise debt going forward. And of course, we'll go into equity and debt in more detail during the following up sessions. So the other question that we get asked a lot in this industry is, should you raise equity or debt? And Kathure has gone into a lot of detail around this. So equity is long-term capital. This is someone who's putting in their money into your business with a long-term view. If you have someone who wants their money back in 1 year, that is not an equity investor. It's, even when you're having discussions with financiers and funders, it's always important to understand, what is their motive? What is their motive? So unfortunately, especially if you're dealing with high net worth individuals and they're Kenyans, a lot of people want their money back, so that is not an equity investor. That is a debt investor. And then there's some people who are interested in growing with you. And so if you have someone who wants to sell, so an equity investor tends to take a different type of positioning, or their motive is different. They're invested in your growth. They're invested in the growth of the business. They're invested in your teams. So even you find equity investors are way more involved in the business because, they have skin in the game. And so the success of their money will grow if your business grows, So you'll find someone who takes equity in your business will sit on your board. I know Kathure mentioned board of directors. A lot of people on the board are shareholders of businesses, so they can have control on how the business is run. And so if you're looking for someone who can walk with you through your growth, through the growth of the business, it's even for you, you need to ask yourself, what type of funder am I looking for? Am I looking for someone to walk with me through the vision and growth of this business long term? If your answer is yes, then you're looking for an equity player. If you're not really comfortable giving out shares of your business, I know a lot of African business, we're not comfortable giving out shares. And remember, businesses are only profitable if they grow. So you can hold on to your very small company and be 100% shareholder until you die, and it won't mean anything. It's even better for you to have 5% of a company that is worth $1 billion in 10 years than have 100% of a company that's worth 50 million. Yeah. So just think about that. Maybe 10 billion. So if you're not interested in giving out equity at this point, that's well and good. Or it also depends on your financial needs. For example, if you're looking to fill up a 20-ton container with avocados, you don't really need equity, because you just need money to get these avocados from point A to point B, and you just need time before this other person is able to pay you back. So don't raise equity for a business that is heavy in working capital. And Kathoria already touched on this. Don't raise equity for a business that is heavy on working capital. You raise equity for a business where you need equity is usually for systems and structures. Let's say you have a power plant and you need to invest in the infrastructure. A debt funder, you're not able, if you're investing in infrastructure, it will take you a few years before you're able to pay back. So debt might not be the best scenario. Or if it's debt, it needs to be someone who's willing to give you a moratorium for 3 to 5 years. And those people are few and far between. Someone who's willing to just sit 3 to 5 years, waiting for you to figure the business out, and then you start paying them back. So in certain scenarios, equity is better when you're trying to build your systems and structures. But when it comes to short-term capital, working capital, debt is the way to go. So the next section will talk about the funders' do's and do nots. So the first thing is, do not oversell your story. So sometimes when we engage entrepreneurs and they're looking to raise capital for their business, there's this thing called the hockey stick growth. Hockey stick growth is like this diagram over here. Everybody in their forecast has exponential growth. It's called hockey. It looks like a hockey stick. Everybody has hockey stick growths. But how realistic is it? By the time you're coming to a funder or an investor and you're saying, look, this is how my business is going to grow, how many times do you think they've seen it before? How many times do you think they've come across how many times do you think an investor has come across business owners who've told them, this is how my business is going to grow? And all the growth charts look like this in this diagram. Very many. In fact, there is no business that will go to an investor and not have a growth chart that doesn't look like this. So the first thing the investor will do is roll their eyes, because they've seen it very many times. So it's very important that you're able to say, look, this is how I think my business is going to grow, and be optimistic. Of course, we don't want you to be pessimistic when you're going to an investor. We want you to be optimistic, but we don't want you to be unrealistic. If your business has only grown 5% in the last 5 years, don't wake up and say, look, I know I've been doing 5% growth in the last 5 years, but I know I'll do 50% growth in the next 5 years, 50% growth per year for the next 5 years. No, if you've not been able to do it in the past, you must have a very clear reason, why you're able to do it in the future. Is there something in your business that has changed? Is there something in the regulations that have changed? Is there something in the industry that has changed that means that you're able to do 50% more? Has a COVID situation happened, whereby you are buying masks at 50 bob, and then all of a sudden, the masks are now 300 shillings? Unless something significant has happened, be realistic. Your past and your future must tie in. The other thing that you shouldn't do not lie about your numbers. The truth will always come out. The Bible says the truth will always find you. I forget which verse it is. But it's very important to be honest about your numbers. Don't come and say to an investor that, look, we are going to do 100 million this year, and very well you're only going to do 5 million. There's no way you're going to achieve 100 million. Or you say that, and it's cooking books. And I know a lot of us cook books when we are trying to get money from the banks, and I'm not here to throw stones because we're all trying to run our businesses. But with equity investors, there's something called due diligence. So if you tell them a story, unless it's a high net worth individual who's not going to go into the details of your numbers, if you're going to approach an equity investor or a debt investor and say, this is how my business has been growing, they're not just going to take your word for it. Yeah, they're going to look at your books and they're going to analyze them clearly to see if it's true. They're going to look at your bank statements. So if you're saying that you've been receiving 10 million, but your bank statements only show that you've been receiving 500,000, the truth will always come out. So just be honest from the get-go. The other thing that you should do, now let's move on to what you should do. select who you approach carefully. Select who you approach carefully. Different funders have different mandates. Yeah. Don't just go out on LinkedIn and send your pitch deck to 3,000 people. You know, I mean, there's this thing where people say, oh, send your deck to as many people as you can. No, 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 no. That is not the approach. Even having been in this industry for over a decade, you know, that's not how it works. What works is when you take a targeted approach and you're very careful about your entry point. Investors actually fund a lot of the time. The introductions are based on relationships. It's based on who you know. You know, so a funder won't give you. Sometimes you might send, a pitch deck on email, and they might never respond to you. But a funder will respond to, and Kathuri, I think this is the time that we can sell ourselves. Some of us, we have relationships with funders. You know, we have coffee with them, we have lunch with them. If we send a pitch deck to a funder, they're more likely to respond to us. Even if it's a no, they'll say, no thanks, Kathuri, or no thanks, Doreen, this does not fit within my mandate. A mandate is, so let me just go back to, a mandate is, each equity funder is guided by certain principles that their fund must abide by. And so some equity investors, maybe their firm mandate is that we're only going to invest in climate tech companies, or will only invest in businesses that have a gender lens or gender theme around it. So it's very important to understand who your target is. Like, for example, if you're going to go to a funder who's very climate sensitive, don't go with them and say, look, I want to transport livestock to the Middle East. You're polluting the environment with all your sheep in your namangombe. You're polluting the environment with so much carbon dioxide. Don't go to a climate sensitive fund to pitch your business. So you have to be careful about who you approach. It's important who you approach, and it's important how you approach them. The other reason the approach is so important, because sometimes it's very good to work with advisors, because our job daily is to approach investors on a daily basis. This is what we do. So after a certain period of time, you understand how they think, you understand how they behave, you understand how to approach, you understand, because even when an entrepreneur goes to pitch, sometimes they'll pitch, but their pitch won't be accepted because they're not saying the right things. You have to be strategic about how you pitch matters. How you pitch, what you say matters, or what you say matters. If you're pitching to a climate fund, you have to use certain language that they're able to understand. You need to use words like ESG and reduction of carbon emissions, and quantitative analysis. We're able to reduce carbon emissions by 20%, and you have proof to show how you're able to reduce carbon emissions by 20%. If it's gender lens focused funds, you're able to say, look, we have our executive management is predominantly female, 60 to 70% female. Or let's say you're a person who has a microfinance, you're able to demonstrate that, look, based on our data, 60% of the people that we lend to on a monthly basis are female. So you need to be very smart about how you pitch and your approach. The other thing that people focus on, and I don't know how many people here fall into that category, but a lot of businesses focus on, where can I get money? Oh, I need money. Oh, I need money. Where can I get money? And sometimes your focus can be so tied up in where I can get money and not focusing on building a high quality business. So it's so interesting. When your business isn't doing well and you're constantly thinking about money, very few people will want to fund you. But when your business is actually doing well, it's sort of like an oxymoron, sort of like an opposite effect. The businesses that really need capital are the ones that are least attractive to funders. But the businesses that don't need capital, they are high functioning, they're profitable, they're high quality. They're the ones that all funders, are looking for. And I remember early on in my career, I learned that when I got into corporate advisory, and all of us were chasing the same businesses. We were chasing all the high-end retailers. At that time, many years ago, we were all chasing the Nakumats and the Bidcos and the whatnots and all of these big names. And when we'd approach the founders of these businesses, they'd always tell us the same thing. They tell us, look, Doreen, we have 10 investors we are talking to. I'll tell you when I have time for you. And that is what you want to be. You want to be a business that is able to say to an investor, look, I have 10 other offers on the table. What is it that you're bringing me? And the only way you can do that is if you're able to build a high quality business. So I do appreciate that it's sort of a chicken and egg situation. whereby sometimes you need capital to have a high quality business, and once you have a high quality business, you might not need capital, but it's always easier to attract funders to a business with strong fundamentals. So like I said, even if you're not able to grow drastically, even with the business that you're running now, are you able to invest your profits into your business, or even generate profits? I think the primary thing is, your primary goal if you're looking for capital and you're not generating profits, that your capital should not even be should not be something that you're looking for. Your primary thing is, how do I generate profits in this business? How do I have a minimal viable product? And I don't want to get too technical. How am I able to generate profits in this business? What do I need to do? So when you're approaching investors, there are specific investor materials that you need to have. So the first thing that we'll discuss is a financial model, and this is very complicated, so I'll try and keep it as simple as possible. So a financial model will have various elements. So it'll have an assumptions tab. Yeah, so a financial model is something that you build out on an Excel sheet. So there'll be an assumptions tab. So what goes into the assumptions tab is key drivers of growth. Like, I assume that my growth is going to be 5% per month. I assume that my price is going to be 10 shillings, like for example, my price is going to be 50 shillings per avocado. My costs are going to be 10 shillings, And then of course there's something called inflation. So how are my costs going to go up over the next few years? You need to have an inflation assumption. So this is where the key drivers of growth, of costs, of, all your assumptions, all your key drivers, all your thoughts around how is my business going to grow should be in an assumptions tab. So the other thing that goes into a financial model is your profit and loss, your balance sheet, and your cash flow statement. So for those of you who don't know what a profit and loss is, I'll show you in the next sheet. So a P&L, profit and loss, looks at what your revenues are. It looks at what your costs are, what your profitability is. Your balance sheet looks at your assets versus your liabilities. Your liabilities are things like loans. Your assets are things like property, inventory that you own. Your cash flows look at how business moves how cash moves in your business. Sorry. So your cash flow, looks at this. This is so your revenues might show, this month I've made 10 million shillings. Yes, you've invoiced 10 million shillings. That goes into your profit and loss statement. But how much have you actually collected? You might have invoiced 10 million shillings, but you've only collected 500,000 shillings. So that's why cash flows are important. So all the numbers that go into these statements, so the statements, remember, are your profit and loss, your balance sheet, and your cash flows. They need to be backed well by well thought out assumptions. So the other thing that goes into a financial model, if you're discussing equity, you need to have a valuation calculation. And there are various valuation methodologies that you can use, and we really don't have time to get into that here. But you need to be able to say, look, based on these numbers, the value of my business is $1 million, or whatever that number is. So if you valued your business $1 million and you're looking at, so assuming that's pre-money valuation, and you're looking for $1 million, it means that your pre-money valuation is $1 million. But then after you raise $1 million, your post-money valuation will be $2 million, which means that you own 50% of your business. And if you've not understood that, it's fine. We'll discuss that in follow-up sessions. So for debt funders, your financial model needs to demonstrate how your cash flows can support debt repayments. P&Ls, profit and loss statements, will not demonstrate how well you can pay your loans. You see, if you go to a banker or any debt provider and you say, look, I'm going to do 100 million shillings worth of business next year. I mean, a debt provider won't care about how much you think you're going to do. They want to know, how much have you actually done, and what have your cash flows been? And so for a debt funder, the cash flow statement is very key. Of course, all of the statements are key, but so much your cash flow statement is very key, because they are very keen on knowing how much can you actually pay, because sometimes the cash flow versus the invoices can be very different. So this is an example of an income statement. An income statement is your profit and loss. So you'll have your revenues, you'll have your COGS, which is cost of goods sold, your SG&A, your selling, general and administration costs, EBITDA. Remember, this is the metric that a lot of debt providers would look at. Even a lot of equity valuers would look at, because sometimes the valuation of your company can be based on an EBITDA multiple, and I'll get into more detail during follow-up sessions. So in a typical financial model, and this one just looks at the profit and loss sheet, you will have so in here you'll be able to see 2019A, 2020A, 2022F, 2023F. So in summary, this is A stands for actuals, F stands for forecasts. Sorry, this is a very old spreadsheet. This person was doing this analysis probably in 2022. And so what they have is 3 years of actual numbers. So the actual numbers are 2019, 2020, and 2021, and their forecasted numbers are 2022 and 2023. Of course, I can't show you a real actual profit and loss statement, because as an advisor, we are bound by NDAs and we can't divulge client information. So this is the best I could do with. So the other thing that a financier would want, especially an equity provider, is a pitch deck. So in a pitch deck, you need to clearly define the problem in the market, the UVP that we discussed, and I'll just go through these points very quickly because Kathure has covered them and I've glossed over them. So you need to understand your problem in the market, you need to have your solution, you need to have the total addressable market, you need to understand the market size, you need to clearly define what your products and services are, what your business model is. You need to understand who your competitors are, who's on your team, who's able to drive growth on your business. You need to be able to provide a set of financials. So in the financials, you need to look at the financials need to demonstrate what your business has done historically and what you anticipate your business will do going forward. And remember, these assumptions need to be reasonable. And then finally, in your pitch deck, you need to very clearly lay out what is your ask. How much equity are you offering your business, and what amount are you looking at? The other thing that investors would look for is a data room. So a data room will just contain, of course, we already discussed, it'll contain, I've talked about 2 sections here. So the data room, it'll be more detailed depending on the size of your company. Of course, the larger your company, you will need things like, ESG compliance and all of that. That will come under legal. But for the sake of this example, I've just taken very simple data room or items that go into a data room. So I'll split it into there's a financial and commercial data room. And then there's a legal part. So the financial and commercial will look at your pitch deck, your financial model will be in the data room. You'll need to have a good set of management accounts or audited financials. Remember, please ensure that these numbers are accurate, because if you give a set of financials that are not accurate, there's something called due diligence and you shall be discovered. Also in your data room, you look at your sales contracts. You can't say that I have 50 clients that I'm supplying to and you don't have any contracts. It's important for you to have sales contracts. What if this person that you're supplying to doesn't pay you back? What happens? It's also important for you to have a TCC, tax compliance, and other relative documents. On the legal side, of course, there's the typical company legal documentation that you must have. Your organizational charts, who's on your team, resumes of some of your key staff members. The legal side of the data room will also contain legal contracts, and IPs where necessary, especially if you're in tech or if you're offering a very unique product or service. So let's quickly just close on the capital raising process. So what is the process of capital raising? So typically this is a pathway that it follows. So the first thing that you do is you send an initial pitch. So here you send a teaser to funders. So what is a teaser? A teaser is an abridged version of a pitch deck. So a teaser will have just the highlights of your business. So the reason why you call it a teaser is because it's not too heavy, because investors and funders get a barrage of emails and messages every day. So they're not going to go through everything. And if you send them a 30-page pitch deck, they're not going to read it. So what you need to be able to do is to send even a 5 to 7-page teaser that highlights the key things about your business. And so that's the first thing that you send. And I remember how I said earlier, how you position yourself matters. So the first thing after you send your initial pitch deck, the investor will say, oh, come, let's have a meeting. You'll talk about your business. You'll do an introduction. The second thing is if they're happy and they want to learn more, they'll ask you, oh, can I have access to your data room? So your data room is the items that we discussed. They want to know, what are your sales contracts? What does your financial model look like? How do you think you're going to grow? What systems and structures essentially do you have in place? That's what a data room demonstrates. Once they're happy with that, the second thing is they'll start negotiating. Okay, fine. Based on the information, based on our team, this first of all, they'll go to something called an IC, which is an investment committee. And then they'll come back and say, okay, fine, we're able to give you $5 million. It's going to be quasi-equity, or it's going to be mezz debt, or it's going to be a loan. They'll give you the terms, the structure. And then what they'll do is, once you've agreed on the structure and the terms, you'll sign something called a term sheet. A term sheet is a non-binding offer. It doesn't mean that they're going to give you this money. What it means that a term sheet is a non-binding offer. Term sheet means that here is $5 million, but we need to do due diligence. If we're happy with the due diligence, we'll give you the $5 million. But if you're not happy with the due diligence, we won't give you $5 million. And that's why I emphasize, don't lie about your numbers, because after you've negotiated back and forth, you've agreed you're going to get $5 million. The next thing is they're going to do a due diligence on your business to just understand, is what you're saying true? What are the risks associated with the business? Is there taxes that you haven't paid? Are there people who are suing you that you fire, people that you fire that are suing you? They want to understand, are your numbers accurate? Growth forecasts, are your clients happy? They'll do a lot of work, and they'll actually pay for it. And due diligence exercises are actually quite expensive, but the client will pay for it. So finally, you'll do the signings of the legals, and then there's things called conditions precedent that you'll discuss. And then once you sign the legals, then you'll get into the financial close. And I think now that we are very well spent for time. So I think over to you, Jackson. I think we can go straight into questions.
Yes. Thank you so much. I know we are pressed of time. We have 7 minutes remaining, and that's why I've posted in the chat box. If anybody has a pressing question, please share on the chat box. We'll not be able to have the Q&A at this juncture, but if there's a pressing question, you can raise your hand and then we'll see it from there. But please use the chat box, because we'll be able to get back to you, and we have your emails, so it will be easy for us to reach you after this call. As you're thinking of a question to post or not, the training that you have received is a crash introductory training. And that's why you see it had a lot of meat in it in a very short time. So we didn't want to compact it so much. That's why we gave it 2 hours for people to understand, especially those who are in business, who want to go into business, and those who are thinking of exiting from the business sector. We're giving you a reason of why not to exit. So those are the key areas we're trying to bring out for you guys to understand that business is not only about opening a business because your friend has opened a business. It's more about doing a background check so that you don't go into problems that your colleague might have evaded and they didn't tell you. Before a business earns any profit, you must go through some loopholes. And that's why we are trying to help you to evade some of the losses that every business incurs during the early growth phase. So at this juncture, as I've said, I can see there are some questions in the chat box. Judy is asking, there's a question shared by Justus. Very good. And maybe we can take those 2 questions or 3. Justus is saying, the quite rich training here. What factors are needed while doing business pitching? What factors are needed while doing business pitching? Maybe this one I'll send it directly to Doreen. What factors are needed while doing business pitching? Just one question. And maybe the other question to Kathure is, how does government policies, e.g. taxation, affect businesses in this context of seeking funding? And then David Njuguna is, how will you share the handout to us? So in terms of the slides, at this juncture, we'll not be able to share the PPT points because some of these PPT points, we'll use it for the second series of training. And due to copyright issues, at the end of the second series of training, that's when now we can be able to share the PDF version of it. But at this juncture, let us use them because we're going to use them in the January training. So maybe to those 2 trainings, questions as we wind up, Doreen, to yours is due. The question was by Judy. By Justus. What is the factors needed while doing business pitching? And to you, Kathure, from Judy is, how does government policies, e.g. taxation, affect businesses in the context of seeking funding? To the others, please keep on sharing your details. Can Doreen share her contact, please? So please, After answering those questions, Doreen, as you answer the question, Kathure, you can be posting on the chat box for everybody on your email. Share your email and your contacts in the chat box, and even the links for people to follow you on those social media pages. So Doreen, over to you.
I think I recognize some of the names in this in the audience here. Shout out to Judy Wanja. So just to get straight into that question is how do you position? And I think if I just read the question here is, how do you position yourself? Which factors are needed while doing business pitching? So, like I said, it's very important for you to have understand who your funder is, right? So, a lot of entrepreneurs, when they're going to pitch, they go to pitch with their business in mind because you've been running this business for so long. You think, and this is where a lot of entrepreneurs get it wrong, you think what is important to you is important to funders. That is actually not the case. Funders, what is important to them sometimes is very different to what's important to you as an entrepreneur. So when you're going to pitch, and this is why you shouldn't just send random pitches to different people. That never works. It never works. Okay, it does work, but maybe with a 1% or 2% probability. Understand who the funder is that you're pitching to. Understand what it is that they're looking for. If you're, if it's agri-tech, if they're in agri-tech, you need to be able to clearly demonstrate that you're running an agri-business, and this is the technology that you have employed in your business to ensure that you're able to be sustainable. If it's a climate, if they're looking for, climate solutions, and you're running an agri-tech, you need to be able to demonstrate that not only do I have tech, but these are the ESG, strategies that we have employed into our business to ensure that we are, reducing our carbon footprint. So it's very important for you to understand who you're pitching to and then curate it to the person that you're pitching. It's the same way when you're dating. I think it's a gentleman who asked this question. When you're meeting someone and you're meeting someone who's looking for marriage, you don't go there and say that you're looking for a short-term commitment when the person that you're pitching to is looking for a long-term commitment. So I just have to reiterate, it's very important for you to understand who it is that you're pitching to.
Thank you so much, Doreen. And please use the chat box, Doreen, to share your contacts, as Kathure will be answering the second part of the question. The question to Kathure is, how does government policies, e.g. taxation, affect businesses in this context of seeking funding? Just in 1 minute. Thank you.
Okay, thank you. I'd actually shared our emails on the chat, Doreen, but you're free to share our Gmail addresses. Taxation is absolutely critical. Remember when I talked about understanding the legal framework? It is important to understand from a policy perspective, what new taxes could, happen upon your business, how do you plug that into the funding request? Indeed, if tax has become a significant risk, I think it is very important for you as an entrepreneur to unpack that. And there are tax experts. I'm not a tax expert, but I certainly know tax experts who can help you unpack those risks. When Doreen talked about understanding your entire business ecosystem, that means understanding your customers, your regulation. Sometimes you could find a funder who you had very good discussions with, but the tax policy has shifted and it's affecting your business adversely, and that discussion could fall apart. So it is very important for you to anticipate that. Secondly, if you're looking at, regional markets, if you're looking at regional markets, you're looking at sourcing a product or services from regional markets, it is very important to understand matters to do with, say, transfer pricing and how that affects your business, because there's a tax element to it. And one of the things I advise my clients is that it is important for you to start looking at jurisdictions, for instance, that have a double tax treaty with Kenya. So you're not getting taxed twice, for example. And that is something investors also look at, because if for every shilling you have to pay 15% here and 15% in another country, so you don't get credit for tax paid in the different jurisdiction, that is very important. So tax is absolutely critical, and tax planning is a must for businesses.
Thank you so much, Kathure. I know you do not have enough time, but you could have answered all these questions more elaborately. But I know we have a training in January, so most of these questions will be answered. But before then, we'll be able to answer the questions. I can see a question from Kitson Mwiti. Could you kindly provide us with the links to available funding opportunities? This will be able to answer you after this call. You have your emails. For Kalondu Mumo, for us who sell in local markets, B2C model directly to work-in customer, how does the contract apply? Is it even possible? Rosaline, thank you, Doreen and Catherine and Dr. Jackson. I am a founder of a non-profit social enterprise in climate tech. And Doreen mentioned we shouldn't send the mass pitch decks to everyone and anyone, that they have contacts. I would like to tap into this guided pitching and the contacts. I believe this is now part of the second training we'll be doing. And that's why we wanted to give you just a taste of what you need to have so that you don't miss the second part of the training, which will come with a certificate at the end of it. So at this juncture, we'll be able to curate the questions you have shared in the chat box. I know there was not enough time, but at this juncture, I want to say thank you so much. Expect a call, expect an email from the emails you have shared with now the second part of the training that will be happening in January. That second part of the training also will be sharing the charges that will be going with it, which is very substantial, so that now everybody can be able to attend. The sooner the better. So we'll be sharing it earlier so that you have 2 months. Plan yourself for the training. The trainings are usually just substandard. They usually don't go as anything above 6,000. So I believe the last training was 5,500. So people will have time to be able to plan themselves accordingly for that training. So at this juncture, I want to say thank you so much, Asante Sana, to everybody, and thank you for attending. And I wish you a good day. Doreen and Kathure, maybe you can just say goodbye, but at this juncture, we are done. Thank you so much.
Thank you. I think let me go first. I had a lot of fun making this presentation. And what I want to tell our esteemed colleagues sitting in this discussion is that these are not stories, these are not myths, these are transactions we have done. They're real life. When Doreen talks about the cycle, it's because she's done it. When I talk about running a business, I've set up a business and run it from scratch. And so if you're talking about governance structures, it's not something that I've gotten off the internet or whatever. Yeah. It is stuff we have lived. It's real. So I look forward to interacting with you in the future. But in the meantime, if you want to reach out, please do. And we'll have all this curated through Jackson.
Thank you so much.
Thank you very much.
Sana. Over to you, Doreen.
All right, I think Kathure has taken the words out of my mouth, so I just reiterate everything it is that she said. Thank you all for making time out of your busy schedules to attend this call.
Asante ni sana. Goodbye.
Bye-bye.